Most businesses have more revenue potential than they even realize. In order to ensure we maximize your potential, let's do some digging to uncover your revenue gold. To increase your revenue, the output, you need to influence the inputs. Now we're going to drill down into your revenue model and find sales inputs, things like inquiries from prospects, conversions, retention rates, etc., things that can be optimized for impact. This exercise will also reveal which products need more cross-selling attention. Revenue is a calculation of the number of transactions per customer multiplied by your price per transaction multiplied by the number of customers. So, if your average transaction value is, let's say, $10,000, and you generate, on average, 5 transactions per client or customer per year, and you have 100 clients or customers, you will have $10,000 times 5, or $50,000, times 100 clients, which equals $5 million in revenue. Now, to increase revenue, you have just a few options. You can either improve your cross-selling, or the number of different product transactions per customer, or you can increase your price. Now, we could raise our price 20%, but that would potentially decrease the retention rates of our customers. Or finally, you can increase the total number of customers. So let's dig even deeper and work out how to calculate the total number of clients. Depending on the type of business, the total number of clients might result from your existing clients times your retention rate of those clients plus the number of sales meetings times your conversion rate. So if you have 100 clients, and let's say you have a 90% retention rate, so you'll keep 90 of those 100 clients. You also have 50 new sales meetings per year with a 20% conversion rate, which then leads to what? 10 new clients. So in this example, you keep 90 out of your 100 existing clients, and you add 10 new clients each year, so your revenue essentially remains unchanged. Now, since this doesn't allow us to grow revenue without raising prices or introducing new products to cross-sell, we will most certainly have to get better at converting our new client meetings. So let's drill down even further to determine the inputs, or the lead indicators, that result in the number of sales meetings. So our sales meetings really equal the number of inquiries from prospects multiplied by our conversion to a sales meeting. In our current example, we're getting 50 new sales meetings per year. So let's suppose you had 200 inquiries to generate those 50 meetings. That means you're converting at a 25% rate. In our example, after examining the overall components of your revenue stream, you might, for example, identify that your marketing campaigns and systems are generating a sufficient number of inquiries, but that these sales leads are not being converted into enough sales meetings. This allows you to then look at the processes such as how the inquiries are being handled and by whom, or perhaps looking at the quality of inquiries that your style of marketing and promotion are generating. Lastly, to predict the impact cross-selling will have on your future business, go back and look at the revenue per product per client. From there, you can look at predicted market share penetration per product and set a realistic revenue goal for each product as well. Yes, what you're doing is big picture stuff, but remember, your potential is usually higher than you think. You also have a documented process of how a certain revenue figure is attainable, as well as which products need more cross-selling attention across your sales organization in order to achieve or exceed your revenue goals.